This is Nordic Climate Talks, a podcast by Nordic Development Fund. Hello and welcome back to Nordic Climate Talks, where we explore bold ideas and practical solutions for climate action. I am your host, Kelly Keodara. Today's episode is all about catalyzing finance for climate action, a topic that is gaining momentum across development and investment communities. Today, we are diving into the world of blended finance and how it can unlock new opportunities for climate investments, especially in the Global South. Joining me are two incredible guests, Malena Rosman, Director of Portfolio Origination and Management at Nordic Development Fund, and Clubb, Managing Director of Convergence. Welcome to you both, Malena and Chris.
Thank you, Kelly. Lovely to be here.
Thanks for having us. Appreciate it.
All right, let's get started. Malena, let's start with you. So blended finance has become a trending concept in impact investment and international development. Can you briefly explain to our listeners what exactly is blended finance and how would you describe its importance for climate investments today and NDF's role in that space?
Thank you. I'm happy to try to cover those very important questions. So talking about blended finance, I think there are a number of definitions, but I would say that we could easily adhere to the definition that is formulated by Convergence. It's about basically blending finance it's a structuring approach that allows organizations that may have different starting points and different targets to join forces in a common structure. And very often, you can see that financial objectives and development impact objectives are in different, on a scale, could be differently, stronger for some organizations than others. So often you have concessional funding that is provided by public organizations backed by governments. And or philanthropies. And then you can join forces with more commercial actors, very often public sector. And you can join into the same structures with different objectives, but still achieving development impact as well as financial returns. And why? And I think climate finance, the urgency to mobilize more capital for climate finance is quite evident. It's not something I think we need to explain. I think it's more getting clearer every year, and especially now when there are changes in priorities, that some countries are not as prevalent in the climate space. I think it's even more important that we try to leverage the financing that we have to mobilize more capital for climate finance. And I think climate investments in climate projects are quite suitable in a blended finance perspective. And if you look at the investments that are being made within the blended finance space, the climate-related projects are dominant. But we can use our catalytic funding and take more risks in a structure together with more commercial actors. So in that sense, we also want to promote some of the Nordic leadership and Nordic priorities, a strong focus on climate, of course, but also focusing on more vulnerable countries and contexts, fragile countries, and specifically for NDF, Sub-Saharan Africa, and low-income countries. And to de-risk investments in those areas or contexts, you really need to provide concessional funding to allow others to come in, and especially the private sector players. And very often the really catalytic funding that can take higher risk needs to come in early to incentivize others to join. So in that sense, we're in a very good position that we can do that. And it also means that we can push for the priorities that we have connected to gender and environmental and social standards, inclusion, etc. And I think gender is very much about going beyond. It's just not something you do because it's the right thing to do, but it's also something that is really developing the projects in a positive direction, and it's good for business. So it's not only about mainstreaming gender, it's really to showcase how gender can be very fruitful for expanding businesses and also to mobilize capital.
Thank you, Malena, for clarifying that definition of blended finance. In today's global context, public finance is quite stretched thin, and the demand for concessional finance is growing. How does NDF help mobilize private capital, and how does it complement financing from other investors and actors?
So when we talk about blended finance, we often talk about a structure where you have different layers, and the different layers can take different levels of risk. So at the first layer, you have what you call a first loss layer, or a junior capital tranche. And that's where NDF can come in. And that means that we are the first movers often. And we come in early and try to create confidence for others to come in. And we often join forces then maybe with other donors, government-backed donors, or philanthropies, as I mentioned earlier. And then when you move upwards in the structure, there are often other players like development finance institutions that may have at least some return expectations. But then sort of the ultimate goal is to also mobilize true private capital, but they are more risk averse. And especially if you look at institutional investors, meaning pension funds and insurance companies, that according to their mandates have to have a certain risk return profile. It's very important that we can come in early and sort of lift off some of that risk from the structure, and by that hopefully mobilize more of private capital that is so well needed. But that means that we have to also be very considerate when we provide funding. So some of the funds that we have gone in and taken a junior equity position, meaning that taking the higher risk, it's the Emerging Market Climate Action Fund and the Africa Go Green Fund, and also the Mirova Gigaton Fund. So they are focusing on climate mitigation and adaptation. So what we can also say, what is very important, as we have found, and a lesson learned, I think, in the whole development community, is that to really leverage these investments, you also need to provide support in the form of technical assistance, which is then funded by grants. And we have the benefit of having a toolbox of instruments. We can use equity as an investment, but we can also use grant funding and also loans or repayable grants, which is a form of loan. But the technical assistance, that is often a smaller investment that you can connect to a larger fund investment, can be used to really strengthen the capacity for the fund manager or for the beneficiaries of the fund, the companies or the end beneficiaries, to include, for example, gender considerations or leverage the business support for these companies to really grow and scale. And we can also finance very early feasibility studies, etc., that can strengthen the structuring of the project and the structuring of the fund. So I think having that technical assistance component is extremely important as an addition to the actual investment.
Chris, can we hear from you a bit? Could you share more about the current state of the blended finance market, and how is it helping bridge the critical gaps in climate finance at the moment?
Thank you very much, Kelly. I'll just start with two very high-level, incredibly important comments about blended finance, and I'll answer your question about the state of blended finance. The first is from a development perspective. Everyone on this podcast, listening to this podcast, should be aware, all good practice blended finance transactions deliver development impact and or climate impact in developing countries. That's the development focus of blended finance. The other side of the focus is mobilizing private investment. And the message we want to send to all private investors that might be listening, in blended finance, we are trying to mobilize or catalyze private investment to good underlying projects that just unfortunately happen to be sitting in one of the 142 developing countries where investors' perception of country risk, credit risk, currency risk, political risk is high. So it's the public sector bearing some of that risk in a way to drive investment to projects that would otherwise get financing if they weren't located in those particular countries. Now, to address your direct question, what is the current state of blended finance? I'll really give you three high-level comments. Number one, if we look at the actual level of private investment that is flowing from global north countries to developing countries, sadly, that level of private investment has been lower in the past decade since the Financing for Development 3 conference in 2015 than it was before. So in general, private investors are meeting their funding their investment requirements, but are forgoing developing countries. As a result of that, the financing or investment gap in low and middle income countries to achieve the SDGs and Paris Agreement has grown from 2.5 to 4 trillion. So that's number one. Number two, we've had a huge amount of trial and experimentation over the last decade in blended finance. There's at least 1,500 blended finance transactions in Convergence's historical deal database for around 250 billion. So there's been lots and lots of trial and experimentation, but sadly, collectively, we're only mobilizing around 25 billion a year after all this experimentation to these countries relative to around 5 trillion of investment needs. So it's only around 2% of the SDG investment needs that are being mobilized through blended finance. The third thing I'd like to say about the state of blended finance is that back in July 2025 in Sevilla, developed countries and developing countries met at the Financing for Development 4 conference, and they agreed on an incredibly important document that's really called the Outcome Document, or Compromiso de Sevilla. And in it, for the very first time, developed and developing countries have a high-level agreement on the importance of mobilizing private investment and using blended finance to do that. So Convergence and several countries and organizations have agreed to take that high-level document and convert it over the course of 2025-26 into a concrete action plan, whereby developed and developing countries would be able to mobilize much more significant amounts of investment if we actually embrace this action plan. At the core of the action plan are 3 core ingredients. Number one, we must create investments that meet the fiduciary and regulatory investment obligations of investors. Number two, we need to be standardizing all of this trial and experimentation over the last decade. We've collectively agreed around 12 models that we think will be able to serve as a standardized package to address almost all the investment challenges and barriers. And third, as you mentioned at the outset, there's a limited amount of development finance resources available for that. So whatever amount is available will probably be coming from developed and developing countries. We need to have a higher level of collaboration amongst them to deploy the scarce resources into these standardized models in order to create those fiduciary and regulatory compliant investment assets.
We hear you. Collaboration is key. Thank you very much, Chris, for that overview. So this next question is for both of you, Malena and Chris. Could you share some successful examples of blended finance transactions or public-private initiatives between both the Nordics and the Global South? And what kind of lessons can we draw from those collaborations?
Well, I could take some examples from blended finance projects that we have, or funds that we have invested in. And like I said, we will mostly focusing on sub-Saharan Africa, but we also have some global scope investments. Our portfolio is quite broad. We have a majority of our investments in blended finance related to climate mitigation, meaning renewable energy, the production and access to renewable energy. Because this is a market that is much more mature, and it's been more viable to find investments in that space. What we're trying to see more of now and to focus on is to move into more of the climate adaptation space. And that is more of a nascent market when it comes to finding viable investments, where it's also where we can play a role and try to create demonstration effects by providing de-risking. But it is, and also coming back to what Chris said about standardization, because it's very much about lowering the perceived risk or the actual risk, especially for larger investors that have a fiduciary framing of their investments, and also the need a certain scale, and also the access to data and transparency in this field. So it's a lot about creating confidence, and that means that you have to create demonstration effects. So that is one thing that we are trying to achieve with our investments. So a couple of investments that we have made, one is connected to climate mitigation, is the Energy Entrepreneurs Growth Fund that provides tailored mezzanine, equity and debt investments combined with technical assistance, as I mentioned before, to early and growth stage companies in the access to energy ecosystem in sub-Saharan Africa. So it's very much aligned with our priorities. And we have in that investment trying to really strengthen the gender equality component by providing technical assistance to dedicated studies and to improve the gender data, and also how to identify gender responsive solutions that are really meeting the needs of women and girls. And we also worked actively with the fund manager to strengthen the results and impact management frameworks. This is a way for us to strengthen the development impact perspective of the investment while we are de-risking. Another investment that an example I could mention is more towards resilience and adaptation, and it's the Insue Resilience Investment Fund. Which has as an objective to improve the access and the use of climate insurance solutions, which are extremely important to provide climate adaptation possibilities and to provide affordable climate risk insurance protection to vulnerable populations and businesses in developing countries.
Thank you. Chris, have you got some examples for us?
I've got many good Nordic examples. There are many good transactions, but we need a higher level of collaboration. First is the SIDA guarantee program that's been active for the last 20 years. SIDA has demonstrated how to deploy a guarantee from a AAA guarantor in a variety of different creative and innovative ways, which is demonstrated to the other potential guarantors how to deploy guarantees. And subsequent to that, their Nordic colleagues in Norway and Denmark have now, in the last 2 years, entered into the guarantee business to really pursue a larger guarantee program for Nordic countries. Secondly, is a very important collaboration called the Investment Mobilization Collaboration Alliance that was led by Danish Ministry of Foreign Affairs, but now has all 5 Nordic countries, including NDF, collaborating on how they will bring some of their own unique individual resources, but really as a collaboration, be able to achieve a much higher level of impact and mobilization. So strongly applaud the Investment Mobilization Collaboration Alliance. And then I'd really like to applaud Malena and her colleagues at NDF. When we look at what NDF has done over the last 6 years, in blended finance, when we look at the individual transactions they've supported, they have supported some of the most important individual blended finance transactions. I'll give you two as an example. The Emerging Market Climate Action Fund, which was led by Allianz Global Investors, is really probably going to be 700 million plus, delivering equity in emerging markets for climate solutions. And Climate Investor 2 is another really good example of delivering very large amounts of institutional investor into emerging markets.
Thank you very much to both of you for sharing those very important public-private initiatives. All right, let's talk a little bit about risk sharing. Malena, you kind of touched it a bit already. So one of the core functions of blended finance is indeed risk sharing. So from both of your perspectives, what kind of risks are Nordic public institutions best positioned to take on, and how does that unlock private investment? Maybe you've got some more insights to share there.
Well, I think we have both touched upon it. If you have access to concessional funding, it's a very good way not only to mobilize private capital and by taking more risk in structures, but it's also about pushing for priorities. And if you look at Nordic priorities that we also represent, like I say, gender, deepening the environmental and social standards, and also really keeping the focus on vulnerable populations, and working in more difficult markets, because I think that's really where we can have an important role, and working in low-income countries, and we can provide patient capital, which is also a scarcity in these markets. So it's all about creating a demonstration effect, and try to lower the perceived risk, and eventually try to mobilize the larger capitals from institutional investors, for example. But knowing that it's a way to go. But we can see in some markets, like the renewable energy is quite mature now, and also microfinance, for example, is something that is now much more well known, also by commercial investors, which is something we just have to push a bit more for other areas that are developing, like biodiversity, blue economy, nature-based solutions, etc., that are more nascent and more risky. So that's where we can try to do more.
Well, I'd like to emphasize to the listener the importance of risk reduction. If we look at the 142 low and middle income countries, and then we look at Moody's, S&P, and Fitch ratings for those countries, 76% of these countries are going to be rated B or lower, with a median sovereign risk rating of B minus. Secondly, if one looks at the currencies of these markets, we've done this at Convergence, on average, there's around a 2.4% annual currency depreciation relative to the US dollar, with lots of volatility. So with those two facts and those two facts alone, it means that most investment opportunities in emerging markets for most global North investors are beyond their fiduciary and regulatory mandates. Therefore, if we want their investment in these markets, we need to be reducing risk. And if we don't reduce the risk, then the money won't flow there, and we'll have a systemic ongoing investment deficit in these particular markets, and we will not be able to achieve the SDGs. Now, there's 4 ways in which one can reduce risk using public sector money fairly. Most investors agree that there are not enough viable and bankable projects. So the best use of public sector funding in this respect is to combine public sector funding with private sector funding to develop more viable and bankable projects. We'll call it project development or project preparation. That's the first use, building a larger universe of viable and bankable projects. The second is we can create a lot of viable and bankable projects, but they happen to be sitting in low and middle income countries with sovereign risk ratings of B and triple C. So most investors will not invest in those projects because of the high country risk. Therefore, the second best thing we can be doing is reducing the risk at a project level. And clearly, a guarantee is a classic good example of reducing risk at a project level. The third approach of reducing risk is, in general, we're trying to mobilize a lot of global North institutional investors, such as pension funds in high-income countries. When they look at investing in these markets, they're looking for size and lower risk. And the best way to do that is at a portfolio level, let's say a fund. Getting public sector funding into junior tiers in these funds will mobilize investors. Therefore, by giving them diversification and then subordination of public sector funding, we're really increasing the investability at a portfolio level. And the fourth is currency risk. We need to understand that just currency risk alone will deter a lot of prospective investors who are not able to or not willing to take this open currency risk. There's several really good precedents on how we can reduce currency risk.
What improvements in policy, financial innovation, or incentives would help blended finance play a bigger role in advancing both the Nordic and global sustainability goals?
Super. So I have a comment for each of those: policy, financial innovation, and incentives. Policy. We think that Nordic and high-income governments need to commit to good practice blended finance to mobilize private investment. They've just very recently agreed at the Sevilla conference an outcome document. Now it's time to allocate a small portion of public official development assistance across the 33 members to mobilize as agreed in that document. When it comes to financial innovation, we've had around 15 years of extreme trial, innovation, and experimentation. it has showed us what is good practice blended finance. Developed and developing countries need to come together now and review that body of innovation and agree which are the most effective and efficient uses of blended finance to scale up private investment mobilization aligned to the new outcome document. And when it comes to incentives, I encourage us not to use the word incentives. In our view, it's much more related to governance. We need Nordic governments and developing country governments to govern their fiscal resources. In the case of Nordic countries, their ODA, and in the case of developing countries, some fiscal resources. And they also need to govern their development finance institutions in order for us to actually allocate some of these resources in a core way, not secondary or tertiary the way it has, in order to mobilize at scale in blended finance solutions that are standardized to achieve the new outcome document.
Thank you, Chris, and thank you to Malena. Well, to slowly wrap this up, we would like to remind our listeners that NDF is hosting the Nordic Climate Dialogues on October 1st, together with partners including Convergence. What are you both hoping to achieve through this event, and how can it help connect actors in climate finance and development?
Yeah, so one thing that I want to flag is if one looks at the most recent outcome document, as I mentioned earlier, developed and developing countries have agreed the high prioritization of blended finance and mobilization. So one thing we definitely need to achieve, and we're really championing this at the Nordic Climate Dialogues in Helsinki, is a higher level of collaboration between developed and developing countries. Convergence is working very closely with OECD and some OECD Development Assistance Committee members with Africa. We're rolling up our sleeves in the next year to get African countries and OECD DAC members much more involved in co-creating and co-agreeing what are the best blended finance solutions at those 4 levels of risk reduction that we just described, that African governments can use some of their own fiscal resources and govern their development finance institutions like national development banks. And then developed countries can use some of their own fiscal resources like official development assistance and govern their DFIs. And then collectively, they can be governing the multilateral development banks towards mobilizing at scale as agreed by these countries. We do not currently have a level of agreement between developed countries and developing countries as to what should be these standardized models. We need to bring these countries together, and we hope that the Nordic Climate Dialogues hosted by NDF can start a higher level of direct collaboration to really identify these most important solutions.
Thank you, Chris. I think, what we talk about is an ecosystem, and that's what you're describing. I mean, it's very much about continuing to bring different partners that have different roles in this ecosystem together and continue to raise awareness and inspire each other to really create mind shifts and start looking for opportunities to collaborate and find those different niches in or spaces in these bigger structures that are needed. And I think and hope that the Nordics can also continue to show leadership. Climate has always been high on the agenda for the Nordics, and I think maybe now more than ever there is a surge for sort of Nordic collaboration and coordination in this space to really try to step up and show commitment. So that's what I hope will be sort of the signal coming out from this, the Nordic Climate Dialogues.
Thank you both for sharing your insights and experiences. We very much look forward to meeting you at Nordic Climate Dialogues, where we can continue the conversation on blended finance and more. Thank you to our listeners for your support. Until next time, take care and keep pushing for climate action. This is Nordic Climate Talks, a podcast by Nordic Development Fund.